right, all right. Good afternoon, everyone. We'll give everyone a couple minutes to log in. Oh, I see a Do. Do, you're there. Solomon, yep, okay. We'll just give everybody a couple minutes to get started. I'm ready to go. Scope Markets is here, ready to go. All right, I hope you can hear my voice. If you can use the text chat and give me a green check and say that you can hear me on your end, that'll be awesome. Welcome everybody. It's early morning here in the US, around 8 o'clock. I know it's in the afternoon. Oh yeah, yes. Thank you, Solomon. I know it's early afternoon. For you guys, it's a Saturday. So I do appreciate you taking this time. You could be in a lot of places, and I can imagine where you could be, but you're taking this time to log in and understand a little bit about markets and furthering your education, figuring out what you will do. So it's awesome. Tag your friends, send them the link if they haven't registered yet. We'll do this for about 45 minutes at most. You can raise your hand if you would like to ask a question, and I'll allow you to do that. I think you can also unmute yourself if you do want to ask a question. That's fine. I have no problem with that at all. Oh yeah, very cool, very cool. All right. Yeah, I see Brian, CK, Caroline. Yeah, it's awesome to meet you guys. At one point, I know I'll come to Nairobi and probably will have a cup of tea. Rebecca, I see you. That cannot be rough. There's no way rough. You're up early in the morning. Early in the morning doing this. It's awesome. Welcome, George. Francis, welcome everybody. All right, so it's 8:02. I know I value everybody's time, and I try to usually start on time and end on time so that you can do other stuff. So this is a simple guide to ETFs, and we're just going to call it what it is, just a simple guide. Hopefully you can take some of this information and add it to your portfolio. You can diversify anything that you're doing with investments. So we'll talk a little bit about this. It's a great way of actually diversifying your portfolio and making sure that you hold assets over a very long time. All right, so I'll go ahead and share my screen here so that we can get going. All right, share screen. If you can see the screen, also give me a green check. Or just raise your hand, say that you can see it. Sometimes I say I'm sharing something and I keep talking and you don't even see anything. So give me a green check if you can see it. Awesome, awesome. Yep, okay, very good. So let's get going. Welcome to a simple guide to ETFs. My name is Peter Jorogi. I'm with PeteandPete Investors here in New Jersey. And I've always mentioned that this industry is highly regulated, and you cannot just go out there and tell people that you're investing money or you're going to give them huge returns without specifying what you do. So this is a disclaimer I usually give at the beginning of each session when I'm talking to anyone about this. There are no guarantees in the stock market. So if somebody comes over and tells you, oh, I'm going to guarantee you 50% return, 100% return of your money, you should be very careful and you should actually run away because there's no guarantees here at all. And you have seen that disclaimer where it says that past performance is not an indicator of future performance, right? Because it's very true. Whatever you made yesterday doesn't necessarily translate to what you'll make in future. So you're going to be taking personal responsibility here of what you do. If you do have an account with a brokerage, usually it's you who's controlling that fund, the funds that you put in there. It's your money, and you should guard it aggressively. It's your money. You work hard for it. You always want to make sure that that money at least can have a good return. All right, so here's my team. Work with these guys. Perhaps you have had a mention of them or met some of them. I know you know Robert. He is a consultant with us. We have a new addition of Tony. Tony is a lead instructor in financial coaching, and he does a lot of work with people if they are in debt and budgeting, figure out what you're doing with your money. He's a great guy. So he does financial coaching there. Obviously, I have mentioned in the past the other Peter that does options, advanced strategies, any kinds of options. You can reach out to him. He will help. We do obviously have Teacher M. She's a facilitator here too, and does a lot of work with stocks under $10. And Timothy. Timothy is actually in Kenya. He has been in Kenya for about 2 months now, but he does a lot of work with spreadsheets. He's building a wonderful course on crypto, which we will unveil very soon. So this is the team that we keep building. They are great guys. They want to help, and you can reach out to any of them. All right, this is me. I don't like talking about myself. So I will just mention here that my passion for finances is just too much. I love talking finances. I'm actually an industry organizational psychologist. And it's funny how you add psychology and money, and it ends up being such a passion. I also have certifications in cost strategy in stocks and futures certification. So you're in good hands when we talk about futures and stocks. I've done a lot of work in this. All right, so here is my why I do this. I have 2 teenage young women, both in college now. Nima is actually finishing college next year, and Sarah is in her 2nd year. And this is my wife, Teacher M. She's part of the facilitator. And this is why I do this, because of them and other families and everything else that I do in foundations and everything. This is why I do it. So the question here is, what's yours? Why do you do this? Why do you want to do this? You must have a good reason to do this. And if once you find out what's your why, then you'll be fine. You'll be so dedicated in doing whatever you want to do. All right, so before you venture in the stock market, obviously, you must have your affairs in order. And I never start talking about stocks without talking about the background of investing, which involves budgeting, understanding basic personal finance, savings, not having debt, and all that information. You must have your affairs in order, right? Because how are you going to invest money if you don't have it? You must have start somewhere. You save, and after you have had a good amount of savings, or you have an allocation of money, putting money to work, then you can go ahead and start talking about investings and stuff. All right. Okay. Now, if you don't know where to get going with this, obviously Robert has several classes that he teaches. We also do have a class that we began on budgeting with Tony, and that can help you a lot. And just putting everything in perspective before you do this. All right, so there are only 3 acceptable investment goals. And once you understand what you're going to do with your money, you will not be stressed out, because money is such a stressor in families and in our lives that sometimes it controls whatever decisions we make. And that's why you see a lot of people in trouble or decide to do something that's so drastic. You wonder what happened there. When you go to invest, these are the 3 reasons you should have. The first one is providing for your family. That's the goal. Your family must have some food on the table. You meet their basic needs. That's where you invest. The second reason is saving for a future need, right? So there will be emergencies in future. Something will happen. And if you're able to take care of such an emergency using money that you saved last year or the year before, then you avoid stresses. That's the second part of it. Save for a future need. You must have an allocation in your account for saving. And the last one, which we keep insisting over and over, is leaving an inheritance to your children's children. So these are the 3 acceptable investment goals. And once you narrow them down and work around everything else that you do, these are the 3 acceptable. You know, there are other goals, but that are not acceptable. These ones are acceptable. All right. So let's say you have open an account with a stockbroker. You're ready to invest. You have money. You have covered all your bases. Now the challenge becomes for an investor: what should I buy, and how do I do this? Because it can become quickly complicated when you start hearing about stocks, ETFs, indexes, mutual funds, options, futures. It just now becomes crazy. And you always want to ask yourself, if I do buy stocks in a certain company, will it be around for another 100 years? That's a very good question to ask, because what's the point of investing in a company that goes under or bankrupt in 10 years and then you lose all your money? And you have seen this happen, particularly in your exchange there, Nairobi Securities Exchange. Companies that were bearing fruit, they were doing very well, and all of a sudden they don't have a return, they are going bankrupt. And you've seen a lot of examples. Companies that continue to operate, yet they don't make any money. So you put money there. If you had put $10,000, now it's nothing. You should always ask yourself, is this company going to be around for a while? Because you want to put money in a company that will give you a return. All right. Then you always want to participate in other ways of investing, not just being stuck in stocks. You figure out, is there something else I can do with my money? Can I participate in derivatives? Can I do real estate? Can I do something else? So you should always think about money being put somewhere that will give you a good return. All right, so these are the headlines that I was quickly going over, and I found a huge activity between mutual funds and ETFs, which has been true for the last 10 years. Over the last 10 years, this is according to New York Times, 900 billion has flowed out of stock mutual funds, and 1.8 has flowed into stock ETFs. So there's a huge shift now between mutual funds and ETFs. A lot of pension funds, companies would have taken money for employees and have a hedge fund that would invest in a mutual fund. And that was the favorite vehicle for investing large sums of money for most companies. But now there's a huge shift. All that money is flowing into ETFs. And there's a good reason why. And that's why we are talking about it today. So this is a headline just recently, about a month ago. JP Morgan is boosting its active ETFs with a 10 billion mutual fund switch. So if these big boys are moving money from mutual funds into ETFs, perhaps there's something there, and you should always follow the money. Don't be left behind with a product or a vehicle that's not moving. And mutual fund is one of those that's now stuck in the mud. And if you don't move your money or figure out to reallocate your portfolio, most likely you won't get a good return because money has moved. And remember, money moves, particularly in currency. And I had actually a very good person tell me, why do you know why it's called a currency? Why is it called a currency? Right? Because it moves in a current. And if you are in an ocean, you see those currents. Sometimes a current can move away from you. It might take a long time to come back. Long time. That's why it's called a currency. So you should always understand that money moves a lot, and it's always looking for where it's going to be treated best. So if money comes to your pocket and you don't treat it well, every time it hits your pocket, you're spending it, it won't stay there. it won't like you. We'll go to somebody that's treating it well and saying, hey, here you can grow, we can nurture you, then money will stay with you. So think about these switches from mutual funds to ETFs. All right, so when you go to invest, you are either an active investor or a passive investor, or both. But the problem with active investing is that a lot of people lose money trying to trade or investing on their own. And they lose money because they have not put in any skill or any education. They haven't figured out how to do it. Yes, they have the money, but they don't know how to invest. They have not taken any time to understand what they're doing, and they'll just throw money in anything that they think is going to give them a good return. So when you do active investing, you are going to be doing this personally. It's you who's managing this money, hands-on. You know exactly which company you bought, whether it has a dividend yield or not. You are tracking this money almost very frequently, hands-on. And it requires you to become now the portfolio manager. So if you are the one controlling your portfolio, your account, you are actually the portfolio manager. And we can come to you and say, how did you do last year? Because you are the portfolio manager. And your goal should always to beat the stock market's average return. Now, what does that mean? There are some places that you can put money and don't have to do anything else. I'm thinking of treasury bills and infrastructure bonds. If they're going to give you 13% return and there's a government guarantee, for instance, from government of Kenya saying you invest in an infrastructure bond, we are going to give you a return of 13% over the next 5 or 10 years, then there's nothing else you're doing. Now you're actually a passive investor, because this is for long term. You're not touching that money, and you're using an index or another way of participating in investing by not having hands-on. So if you're going to be investing on your own, remember the goal is to beat the stock market average return. And on average, here in the US, most hedge fund managers and portfolio managers look to beat S&P. S&P tracks 500 huge companies, and they have an index called SPY. So if you beat S&P 500 average return, you're doing very well. And that return has been on about 7 to 10%. So if you put money to work and you're beating the stock market, now you are actually doing better than the stock market. And now you're growing that money at actually a fairly good rate. So that's your goal. If you are not beating the stock market on your own, then go ahead and put that money passively. Let it just grow on its own by using something like a mutual fund or ETF that we're going to talk about in a minute. All right, so that's the difference. You have to understand active investing and passive investing and what you're going to do there. And personally, I do both. There's things that I want to actively understand what's happening. I can have an income every month. And then there are others I have not touched for a long time. And there are some companies that I won't even look at for the next 20, 25 years. All right, so that's passive investing. All right, so let's talk about ETFs now. What are they? An ETF is the definition, the actual definition is that an exchange traded fund or funds. So you have ETF or ETFs, plural. And this is a fund that is going to include assets in one place. And the best explanation I can get you is, let's say you want to buy Robert, you love Robert, and you're saying, I'm going to buy him fruits. So you go to Naivas and you are looking for fruits and you find grapes, for instance, or bananas. And so you buy him a bunch of grapes, bananas, and you bring it to him. He's happy because, you know, you gave him fruits. Or you can think about not just, why not just get a basket of fruits instead of just grapes? I'm going to add there kiwi, oranges, pineapple, and just it becomes now a wonderful fruit basket. And now you can deliver it to Robert. He can choose from that basket whatever he wants. It's still a bunch of fruits. It's just that there are so many of them in one basket. And this is exactly the same thing with the ETF. So you have a basket of assets put together and you can purchase them. So you can take a bunch of stocks, bundle them together. And you guys know what bundle means, from M-Pesa and Safaricom. That bundle, you're buying data, everything is in one place. So this is the same thing with ETFs. You can accommodate commodities, bundle them together, and then just have one price for it. All right. So this is those funds are traded on exchange, and we have previously mentioned exchanges is a place where you have buyers and sellers. So New York Stock Exchange, Nairobi Securities Exchange, this is just a market. Somebody is willing to sell you something, you're willing to buy. So these ETFs trade in those exchanges, just like stocks. Okay. All right. Now, these are very similar to mutual funds. ETFs are very similar. So if you understand mutual funds, then you won't have a problem with ETFs, because the same kind of basket can be found in mutual funds, bundled together, and you buy them if you like. So ETFs typically focus on a sector or a certain index, and they will go ahead and isolate those sectors into bundles. So these ETFs have ticker symbols, very similar to stocks. And obviously, you know what ticker symbols are. If you are looking to buy Alibaba, you're going to search for the ticker symbol BABA in New York Stock Exchange. And ticker symbols have a unique way of being shown in exchanges. So the fact that Baba is the one you look for at New York Stock Exchange. If you go to Hong Kong Stock Exchange, you won't have the same ticker symbol. It will be a little different. They have their own way of figuring out how to list Alibaba. And in this case, it's actually a number. All right. So ETFs have the same way you look for a ticker symbol is the same way you look for ETFs. Now, these ones will add diversification to a portfolio. What does that mean? If you just buy Alibaba, that's one stock. It's just one company. All your money is there in one company. But if you buy an ETF, like we mentioned previously, now you're buying a bunch of companies all together, and it's going to diversify. So if you buy an ETF that is tracking energy, for instance, so now you have a bunch of companies bundled together and you own them. All right. Now they have usually very low ATR. What is an ATR? Average true range. ATR is just a simple way of figuring out if I'm buying a particular company, on average, in the last 14 days, what's the movement up and down? On average, does it move 2 points, 3 points on average? So this is micro S&P. On average, it moves 41 points every day. So you expect on Monday, it will move 40 points up or down in either direction. So 44.08, you can figure out it may move to, so it says 40 points. It can move all the way to 44.40 or all the way down to 43.60. So on average, that's the movement. But ATRs are usually very slow. They're not volatile. They move very, very slow. So that ATR doesn't give you a heart attack. On average, you'll know that I can sleep better. So this one, for instance, the ATR here is 0.27, 27 cents up and down. It's not going anywhere. No matter what happens in the market, you know, on average, it won't move beyond 30 cents in the last 14 days. Okay. All right. So that now becomes a good thing, because a low ATR, if I don't have to worry about it, I can just buy it and let it go. All right. When you're buying ETFs, you don't have to pick a winner or a loser. In this case, if you're looking at domestic and international airlines, and I know Raf loves Delta Airlines. But Raf, if you are thinking of other airlines, not just Delta, something happens to Delta, then your money goes down the drain. But if you don't care about so much about Delta and you want to own American Airlines, Alaska Air, which other ones? Boeing, which is also part of airlines. Now you can just buy jets, JETS, all right? Jets. Actually, it's named appropriately for airlines. And this one, you're going to own 41 stocks in that sector. So you don't care about who's doing well, who's not. Now you own all the airlines, domestic airlines. Now you can rest easy. If that whole industry starts tracking, the pandemic is over, people go back to flying, then it becomes profitable, you're good. All right. Let's say you also want a technology sector. This is just general technology sector. 76 stocks, you'd look at XLK. All right. Now, let's say, and I know this is going to be a popular one. Weed, medical marijuana, that whole madness, that whole sector, you don't for sure know what you should buy. Is there Tilray, there is other companies that you may want to buy, but you don't want to just buy one. Now you can go to Pot X, also named appropriately from Pot. All right, so I have Asaf asking a question there. How is the price of an ETF determined? Listing price, or is it computed like an index? Oh, very cool. I'll answer that question. Just listen in. Let's keep going here. How is it priced? That's a good question. We'll answer that question. All right, it reduces risk in a portfolio. We have mentioned that. And reduced risk means reduced reward. The fact it doesn't go crazy every day also means, here you go. Let's do this one. So let's say we are buying this ETF, AGG. And we only know that it moves 27 cents in a day. So 27 cents, if it has to move up, that means from 115 plus 30 cents, now you can start adding how many days it will get to 116. So now you realize that it might take a long time. If this ETF was going to move, it takes a long time to go. So see, this is from 2019 when it was established, and now it's at 115. So that's only about 10 points since 2019. So don't expect a huge movement if you're going to be trading ETFs, particularly those that have low ATR. So we'll talk about those ones that can move. And that's just a reduced risk means reduced reward. Okay, now let's talk about types of ETFs. We have leveraged ETFs, and leverage, if you have taken some time to think about it, is just margin. You go to a broker, they provide you with margin. You can borrow money from them so that you can trade or invest. They are loaning you the money. Let's say you have a portfolio of 20,000. You open a margin account, the broker will look at 20,000 and they can offer a credit line. They can say, okay, you have 20,000. We are going to allocate $10,000 more to that account. If you ever need it, it's right there. You can use it to buy stocks or invest. But when you do, you are actually taking a loan and you have to pay interest on that loan. It's not really a lot of money for some brokerage accounts. It comes out to probably about 8% per year. But if you're going to be making more than 8%, then it makes sense to borrow from them to invest. So those leveraged ETFs are going to allocate funds in that ETF, and they will try to amplify the movement. If they are tracking, for instance, S&P, and you invest in SSO or SPUU, so these are ETFs, what they are going to do is give you a 2x return from what you should have gotten from SPY. So if SPY was going to give you $100, these ones will give you $200 because they are tracking that index and they are trying to multiply the return by 2 times or 3 times. So these are leveraged ETFs. So here's a good example on Morningstar. So I did this analysis where you have SSO, that's the ETF, and you're comparing it to SPY. This is the index that tracks the 500 companies in New York Stock Exchange. So it's just a comparison. You take SSO versus SPY, and you notice that the blue is the SSO, and the orange, is that orange? Yeah, that orange is SPY. Okay, so if you had invested $10,000 in 2011 in SPY, the ETF, your return right now would be around $44,000. You've still done well. That's almost 4 times your money. But you notice that SSO, because it's using leveraged, it's giving you twice the return of the money that you put in. SSO is actually could have given you a return of 123,000, right? 2 times or 3 times, right? So when you do leverage ETFs, you have to understand that they use complicated trading techniques. So they'll use derivatives, options, futures, and they will try as much as possible to give you a return twice or 3 times the amount that you have put in. Okay, so if you had done this leveraged ETF on SSO or SPUU, you're getting 2 times the return. UPRO, SPXL is giving you 3 times return. Okay, so that's why you see a lot of people will look for these returns using ETFs. And that's a very good example right there. If you're looking for leveraged ETFs, remember, it's a margin account. You are paying alone on those leveraged ETFs because they're borrowing money. But if you invest in them, they give you a good return, 10,000 to 123, not bad. Okay, all right, then we have inverse ETFs. And just like the name inverse goes, it's against. If one thing is going up, this one will go down. Inverse is doing the exact opposite. And these ones are constructed so that if there's a market downtown, usually the market goes up over time. But then there are these instances where we have a bear market. The market starts going down, it's bearish. Everybody is scared. For instance, during pandemic last year, the market dropped quite a bit, more than from 30,000 on Dow all the way to 20,000. You see, that's a huge dive. And now if you had secured your portfolio, understanding that you'll get a market turnaround, and you had bought insurance on that account, so that if something happens, this one gives you a return. And in that case, you would consider SH or PSQ. And let me just give you this, SH and PSQ. So you notice on this chart, on the left is SPY, the index, 500 companies. Over time, it's been going up, except for this one time last year. It was trading at 338. The pandemic affects the entire world. It drops all the way to 216. See, 338 all the way to 219. That's a huge dive. But you notice on this other one is SH. So this is the inverse of SPY. You notice this one is going up, this one is going down. It's inverse, opposite of it. The only time you have a return on your money on SH is if S&P drops. If it goes down, you are guaranteed that S&H will go up. And you notice here now during pandemic, while S&P was down, SH was up. Notice there $22 to $33. 21.19, you can also call it around $22, $33. You see how it's going against S&P. So if you're thinking of securing your portfolio and something happens to the market, you can always consider this one, SH or PSQ. And those are just 2 examples. There's a lot more. All right, so we did the same thing. We took SH and SPY. And let's say you had invested $10,000 in SPY. You notice the yellow, the orange line, your money has given you 344% return. SH, on the other hand, you have lost 82% of your money because it's going against. The only time SH will make money for you if this whole index starts dropping. So just understand that, I can secure my portfolio by buying an SH, something that is going against the market. Okay. All right. Then we have inverse leveraged ETFs. So we talked about leveraged ETFs, inverse ETFs. Now this is inverse leveraged ETF. So it's combining the margin and it's going against the index. So these ones will give you both leverage and will track that index. If it goes up or down, is going to mimic that index by going negative. So SDS is one of those. If SPY is going up, this will go down by twice the amount or 3 times the amount. And this can become a little tricky because the only time that you make money is if S&P drops. If it drops, then now this one is giving you a 2-time return. So you notice here, SDS and SPY, same thing, $10,000, 2006. S&P is just, I think that's just a base. It's not going anywhere. Then it drops here. And you notice that drop gave SDS a huge boost. So your $10,000 is now almost 100% return. But then S&P started going up. What does inverse ETF do? It has to go against S&P. And now this one has given you a return of 371%. You are now 99% lost on your account because it's going against twice. It's actually going twice the opposite. And that can become a little scary. So this one goes $2 up. This one goes down -2. All right. So just understanding what you're investing, whether it's leveraged, inverse leveraged, is a good idea. If you just want to buy ETFs that don't have that complication, just buy regular ones that we mentioned, such as JETs. All right, so now let's get into asset categories. The market is huge, and you want always to figure out some of these assets. Now, US equities, broad market, is always tracked by 4 indices: SPY, NASDAQ, Russell, and Dow Jones. And you can easily participate in those 4 indices by picking one. If you want the entire 500 companies, you buy SPY. You want the entire 4,000 companies trading at NASDAQ, you buy QQQ. 2,000 companies, IWM. 30 companies, Dow Jones. So 30 companies specifically tracking that index, you can just buy Dow Jones. All right, now we go to sectors. We have a lot of sectors, consumer staples, you have health sector, you have transportation, you have a lot of them. And I'll give you examples here. SMH, semiconductors, transport is XOP. So you can choose just a particular ETF and buy that sector. Then you have non-US equities. So you don't want to buy anything in the US. You can look for or scout for other places in the world that are doing well and look for an ETF there. All right. How about real estate? You can also think about owning an entire real estate sector. You can choose an ETF sector there, or even bonds. So each sector will have its own ETF. By the way, ETFs, they're just too many. And at one point, we may want to ask ourselves, how many can we buy? Because there is almost an ETF for almost everything. If you look for an ETF, you'll find it. Most likely, you'll find it. All right, so here's a few examples. You can find more on our Discord channel. This is our membership portal. We do list all these ETFs. So if you're looking for equity indexes, you'll go there. Treasury bonds. So this is a good one. You want to participate in treasury bills and treasury bonds here in the US. you don't know how to do it, just buy an ETF like TLT or TBF. All right, let's say you always wanted to own gold. All right, you wear gold or silver, but now you want to invest in it. You can go with GLD or SLV. Now, GLL and GDX, these are miners. They go out there and they mine for these metals. If you're looking for such miners, then you can do SLV, GLL or GDX. All right, energies, UNG, that's gas, natural gas. USO will be crude oil. So you want to buy crude oil, you think it's not going anywhere in the next 10 years, you're still going to be driving vehicles, then you can consider USO. Currencies, let's say you wanted to own euro, you'll do FXE. And if you wanted Japanese yen, FXY. And if you wanted the entire banking sector in the US, then you'll do XLF. All right, these are more, see, healthcare, consumer staples, real estate. So there's a whole lot of them. All you have to do is find that particular ETF and start looking at the details of it. So ETFs, the fact that we mentioned they have very low ATR, there are some that are very liquid. And liquidity means you can get in and out very quickly. So these ones are traded almost like volatile stocks. And this is just a few examples. These ones you can buy and sell very quickly because they have a ATR that's a little higher. So SPY, Dow Jones, those ones will be a little faster than traditional ETFs if you're trading them. All right, so let's do ETFs and mutual funds because you need to understand the differences between these two. Should I do a mutual fund or should I do an ETF? And having that definition is going to help you to make a choice. Now, ETFs are very tax efficient. You get actually the tax return when you're filing for taxes, you don't pay as much as mutual funds. So that's one good advantage. All right. Then they are also, whatever they are holding in that ETF is going to be disclosed on a frequent basis. So they'll say, we had 10 stocks that we had bought in this fund. We took out Alibaba, we replaced it with JD. So you exactly know what that ETF is doing. And if you don't like it because they added a particular stock, then you can sell it. But mutual funds, on the other hand, they do not have to tell you or disclose what is in there for more than 30 days. So you will stay blind for 30 days, not knowing what's happening with it, because it doesn't necessarily have to give you that information. Now, the other disadvantage of mutual funds is that there's something called NAV, net asset value. So they will take the net asset value, give it a price, the market gives it a price. And at the end of the day, they'll say, this mutual fund is now trading at this price. You cannot sell it or buy it until the following day. And that's a problem because there's nothing you can do. That price, if you're looking at it, will not change the entire day until the close. Then it changes the price the following morning. Now you have a new price for mutual funds. So this can become a little tricky if you wanted to get in and out. All right. You can buy ETFs for the price of one share. So I know there was a question about how it's priced. Just like a stock. You take AGG, for instance. Here you go. The one we were looking at earlier, AGG. So this one is tracking the US bond ETF. And if you wanted to buy it, one share is $115.87. Almost the same way you would price a particular stock. So that's how it's priced. Just like a stock, just think about stocks and replace the ticker symbols with ETFs. Okay. Let's see, I think I missed something there. Let's see if there is a guideline there. Correct. Oh, I have to go back here. All right, guys, let me know if I'm still sharing because I may have missed a slide there, maybe not. Okay. All right. So we did mention that ETFs have, they are very tax efficient. You can buy and sell them just like regular stock during the market open. And this is an advantage because if the market is falling and you want to get out by 10 a.m., you can easily sell it, just like a stock. Mutual funds, you'd have to wait until, like I said, the close and do it the following morning. So this is just a summary of benefits and disadvantages of mutual funds, ETFs, and stocks. And you notice your capital gains control. You don't have any control in mutual funds. You do have control in ETFs and stocks. The ability to sell short, you can go in, and the same way you can go long, you buy to hold for a long time, you can also sell them short and participate in their down movement. So ETFs and stocks, you can sell them short. You can purchase on margin. Mutual funds, you cannot. They are very transparent. You notice mutual funds, sometimes they are not. Intraday pricing, mutual funds has an X, and now management fees. So if you're going to be buying a mutual fund, on average, you're going to pay 1.4% of the portfolio that you have. And an ETF is as low as 0.7%. So that's a big advantage. Stocks don't have management fees because you're the ones that are putting money to work. Mutual funds do have these 12B1 fees that is also going to attract about 1%. So you add 1.4%, 1%, you see how now that becomes a little expensive. And the benefits to diversify, you can do that in ETFs and stocks. Okay, all right. So I know I presented this earlier, and I did mention that to an American, a cow is just like any other. And if you're going to be doing this, particularly buying stocks in the US, you better know your cow. In this case, you have to do some research on ETFs. You have to dedicate some time in understanding what you're buying so that you get a good return in it. Just like the Maasais dedicate lots of time, they know which cow is sick, what's happening with this bull, should I sell it or not? The same way, that's the mentality. Think about it. You must have a cultural schema to put some work into research. Okay, now, I know we still have some time. Let's go ahead and make use of a screener. So let's say you have no idea what to buy. You don't know where to start. There are so many websites, so many of them that can help you do this. And one of them is ETF.com down here. So you can go ahead and write them down or take a screenshot. ETF.com bar chart. Actually, all our members have accounts at bar chart. By the way, all these are just free accounts. You don't pay for them. Bar chart, Finviz, and Morningstar. These are a good place to start researching for ETFs. And I took a screenshot of ETF.com. You go to ETF screener. It will populate one of these. And you notice it's the map of the world. So what they have done is look for a major ETF in each of these countries, and they'll give you the ticker symbol and how it's doing. So in the US, SPY is the one ETF. This is the index that everybody understands, they know. Actually, the world looks for what's happening in SPY as a benchmark. And so far, it's been negative 4% in the last 2 weeks. Mexico, EWW, if you wanted to participate in Mexican ETFs, that's the one you buy. We have one in Peru. Africa has an ETF called AFK. It's actually negative. It's not been doing very well. South Africa, Egypt. So you see, this is a map that can give you a place to start. And like I said, there are millions and millions of ETFs around the world. So we have populated all those ETFs in one place. We call them ETFs core strategy. And from 115 all the way to 130 something, 180 something are ETFs. And those ETFs, there are so many. See, if you wanted to buy something in Germany or Sweden or Australia, you'll find them there. EWG, Germany, EWD, Sweden, EWA, Australia. All these are just ETFs. So there are so many of them. That's why we would use a screener or a website to start narrowing down your search and figuring out who's doing well. So if you're thinking Chinese market is going to recover in the next 2 or 3 years and it actually beat the US, then you consider MCHI. If you're thinking the Japanese index will do much better, you go there. Australia, you go there. So this just gives you a perspective of where to put money as diversification. All right, I'll jump into FinViz now. But before I do that, when you are a member of our community, it's we make it a little easier. If you're going to do ETFs, we have a specific channel for ETFs where I will do a spotlight on ETFs. And these are ideas that we present almost every week, every other week. So you're always considering something new. So I did post this the other day. If you love coffee, don't just drink it. Think about having a return on it. So you can do it either by futures markets. Although right now it's you cannot trade coffee by itself in the futures market using TD Ameritrade. There's some brokerage accounts that you can do, but TD Ameritrade and TradeStation don't have futures markets on coffee. But there is an ETN. Oh, we didn't talk about ETNs and ETFs, but I think just about ETFs, exchange traded products. We should actually call them ETPs, not even ETNs or ETFs, because they do almost the same thing, exchange traded products. So they can come in form of notes or funds. So that's why it's called ETN or ETF. So if you're looking to buy coffee, you can do an ETN using the iPad series Bloomberg Coffee Sub-Index. This is the ticker symbol ETNS. Right? And the current price when I was looking at it was 51. That's the range for the 52. It doesn't have a dividend. The expense ratio, you always consider how much are they taking out for expenses, because this can become a little pricey if you're not careful. So if you're going to buy coffee using ETFs, you can consider PBJ, XLY, then you start looking for the fund basics. How much is the expense ratio? How much is the price? Is there a dividend on it or not? And you can also buy stocks if you wanted to trade coffee, like Coca-Cola, KDP, Smucker products, McDonald's, QSR, Starbucks also does coffee. So you see there are at least four different ways that you can trade coffee. This is the other one that I will usually give out as a spotlight. So members will get this on Discord, KWeb. I'll tell them what it is. So this is a China internet ETF. And the good thing about, remember, ETFs is a basket. So let's say you don't want to buy Alibaba. You don't want to buy JD. You want all of them. And this is tracking the internet index in China, KWEB. So I'll tell you the current price, the 52-week range. It has a dividend yield, and that's the expense ratio. So we'll also tell you the entry and probably your exit and your stops. Okay. All right. So let's go to risks with ETFs, because everything has a risk. You should think about these ones. ETFs can be small. The fact that there are so many of them, you may want to know what it is. Some have, the market cap is just too low. They're so small, but they'll make it look like it's a big index, but it's really not. So think about what you're buying. If it's just a small micro cap ETF, most of those don't do very well, right? So the top 100 ETFs account for 74%, all right? So look for those ones that are doing much better. They have better holdings than just tiny ones. All right, so ETFs can also have tracking errors. So remember, they are tracking an index or following a particular pricing system. They can have errors, particularly these ones that are leveraged and inverse leveraged ETFs, because they are using derivatives, options and futures markets. Remember, those markets are almost 24 hours, 6 days a week. So trading overnight is not the same as trading during the regular session. So they can have tracking errors. If there was a movement overnight, particularly for crude oil, and that's not reflected during the regular session, then it's not tracking as it should, right? And so those are the tracking errors, and the buy and sell numbers can also be skewed for some of these ETFs. And then I asked a question here, are there too many ETFs? That's a question we should always ask, because there are just too many and they keep growing. Maybe we should figure out good ETFs and not just think that we can buy any of them. All right, and then I did say that there are other numerous tricks that I've not stated here. So be aware of those ones. Okay, so let's go to chart. Let's see. How is the price of an ETF determined? So this was the question that Asaf, I think did I answer this question? How is it determined? The market determines the price based on what's happening with that sector. So I give an example of jets. Let's just use that one. Domestic and airlines. So if you have 41 companies that are consistent in jets, all of them make up that ETF. If there is a problem with that industry, and this is a good example during pandemic, so no one is flying, nothing is happening with the airlines, that affects the pricing of that ETF, and the market will determine. Remember, what the market does is figure out, should equity be trading at 40 or 30? And if all of you agree that it's going to be trading at 30, that's the price. If Tesla is trading at 700 and everybody says, no, it should not be trading at 700, it should be trading at 1,000, that's the price that the market gives it. So the market can be right and it can be wrong. So that's the market that does this pricing every day, and you're given a price based on the buy orders and the sell orders. All right. So some of it is computed by algorithms, but most of the time it's the market deciding. Next week, SPY, there's a lot of issues with Corona and all that stuff. So they think it should not be trading at 400. Everybody starts selling off, the price drops. Okay, so I hope I've answered that question on Asaf. All right, which is the other question here. With ETFs, are there guaranteed returns? Okay, so with the dividend yield, they will go ahead and point out. So for instance, this one that we mentioned, was there one that we mentioned here? Dividend yield of 1.17% on KWeb. So they're taking all these companies, Baidu, Bilibili, Pinduoduo, JD, all these companies will report a certain dividend. So if Alibaba reports a big dividend and JD does not, they will compute the math on all of them and give you 1.17%. So Alibaba might be giving a dividend of, let's say, 5%. JD has nothing. Pinduoduo will do 2%. Baidu will do 0.5%. They will compute all that and give you 1.17%. Okay, all right. Let's see. Why are some green? Okay, which ones are those? Like the one in China. Oh, okay, all right, yeah, I understand. All right, so this is a good question. Why are some green? All right, so this is when you go to ETF.com and you're screening for ETFs, it'll give you a map of the world. And it will tell you that SPY, the ETF for SPY, has lost value by 0.95% in the last, whether it's 1 week, 1 month. Most of them are now negative. In other words, they have lost ground. It's just like if equity was trading at 40, now it's trading at 30, maybe it has lost at least 1%. So it will read as 0.95% down. The Chinese ETF is actually going up. It's doing better. That's why it's green. And the stock market is usually has these colors, green going up, red going down. It's very distinct. You look at the chart, you see green candles. That means what? The market is going up. You see red candles, it's selling off. Okay. I don't know why they choose these colors, but this is what the colors are standard. Okay, let's see. Is there another question here? Okay, so no more questions there. Now let's keep going. Maybe we can do a screening here if you have the time. 9 o'clock, we're almost done. I'll do a screening very quickly here. I did give you websites that you can use to do screening. One of them is ETF.com. What you will do, you can sign up for an account or not. But if you go to ETF.com, ETF tools, ETF screen and database, it'll give you this. And now you can start looking for ETFs using location, geography, economic development. So let's do region. Now you see Asia Pacific, emerging markets, global, Latin America, Middle East, and Africa. So if you're looking for ETFs there, it will give you ETFs in Middle East and Africa. And now you can start looking at them and say, okay, that's Saudi Arabia. This is Israel. That's Israel. This is Africa, AFK. So you click on AFK. It'll give you popular comparisons. If you wanted to do a comparison between AFK and SPY, AFK and IVV. So you're just comparing who's doing better. All right. It'll give you an overview, efficiency, expense ratios down here, portfolio data. It has a dividend yield of 3%. The next ex-dividend date, number of holdings, 72. All right. And then it'll give you the performance there. And the top holdings for AFK, you see Safaricom is right there. The top holding, 6% of that fund, they own Safaricom. So if you are thinking, instead of just owning Safaricom, you're thinking of Naspers and all these other companies listed here, then you will look at AFK. But how about you compare AFK? Would you rather have bought AFK than SPY? So it will give you a comparison on the chart, AFK versus SPY, who has done well. So it will tell you the expense ratios for both. AFK is only 64 million assets under management. SPY has 410 billion. It dwarfs that one. This is nothing at that point. 76,507. And then the costs are here. And now there's a chart here. If you had bought SPY, you're doing better than AFK. Your return here is about 33%. AFK is only 20%. And at one point, actually, it was tracking very well with S&P, very closely. And then after the pandemic, or sometime in July 2021, there's a divergence there. AFK started dropping, yet SPY continued going up. Okay, so that's one way of doing it. You can also go to Morningstar and track it here under research. You have ETFs. You can go to FinViz on the screener. You go to the industry and do ETF. All those are exchange traded funds. Now, let's say you are looking for large ETFs, and now you only have 3. Out of all of them, 2,000 ETFs, if you're looking for just big ones, 10 billion to 200 billion, you only now have 3. Okay. Then one more bar chart. You go to ETFs. They have their own way of saying, they'll say top 100 ETFs. When you see something like this, it's them, it's according to them. So don't always go with, oh, these are the top 100 ETFs. No, this is according to them, and they could be wrong. So don't always verify. Any information you get in the stock market, always verify. Okay. All right. So those are the 3 different ways of screening ETFs. And when you do take a class, and now we can talk a little bit about that one. I think my time is almost up. So I'll mention here that this was an article in Daily Nation at one point. I wanted to give people information about investing. And at one point I did lose all this money. Do not make the same mistakes that I did. Then the reason for that article was well put, that take a class, understand what you're doing before you put money to work. And I want you to make any mistakes. That's why I do this. I gave examples of Susie Orman, Martha Stewart, Walt Disney. All these had failed. They had lost money, but they turned around and did very well. All right. So if you do want to join our membership and take our classes, I'll quickly point out here, if you are a member of our community, It only takes very little money. 1,000, if you want to pay monthly, it's just 1,000 Kenya shillings. You will join our community. I'll send you 2 apps to download on your phone. You will see information that we provide to all our community investors. If you just have, you want to do it monthly, 1,000, yearly, 10,000. So just for $10,000, 10,000 Kenya shillings, you'll join our community and you have access to us. You can ask a question. And if you're a gold member, this is 20,000, you do very well, because now you can at least reach out to me. We can talk about what you're willing to do. I can guide you there. So this is just membership. There are lots of classes that we offer on beginner courses, stocks trading courses, options, futures. So if you go to our website, you'll see all the courses that we offer here. A beginner class is only $249. We'll take you from, we'll assume you don't know anything about the stock market, and we will take you from there. Step 1. Then you can go to stocks trading course, then options, then futures. If you're in debt, you may want to consider this class. Then you can also do one-on-one sessions. So you can either, if you are using M-Pesa, let me list that one more time. This is my M-Pesa number and my names. You can take a screenshot of this. Once I get a link that you have made a payment, I'll reach out to you personally. I'll make a phone call to you. I'll go over what you're expecting, what you're looking to do, give you access to our Discord app, give you access to our Wix app, and we can get going with, this is how Discord will look like. We have a lot of channels there. We have stock, day trade picks, options, dividends, ETFs, watch lists, futures, recordings. It's packed. It's a library of lots and lots of information. Okay, now the Spaces by Wix app will give you access. Is actually the same thing as our website. So let's say you wanted to, you have enrolled in a class and you're looking for information on that class and you wanted to RSVP for that class. You just RSVP. If you have already paid for Crash the Debt and you're looking to attend session 2, all you have to do is RSVP, get the meeting ID and log in, and just log in into that class. All right. And all these are events and classes that for those that have already signed up, you can find them here. All right, let's see. Anything else that I need to mention here is there is 80 trillion global stock market. There's lots and lots of money here to be made, and find a way of tapping into these markets and make money while you sleep. All right. Oh, there's a couple more questions here. Sorry. Okay, how important is it to use ETFs? ETFs will diversify your portfolio. So if you are not those people that want to look at the stock market every day and you want diversification in it, ETF is a very good way of doing it. And then it gives you exposure in a particular sector or a particular economy. So if you wanted to participate in the US economy and buy all the 500 companies in S&P, then you just buy SPY. That's how important it is. And that's why I did mention, you may have come in a little late, I did mention that there is now a huge shift from mutual funds to ETFs. Lots of money is moving from mutual funds to ETFs. All right, Terry, there's a question. Why is AFK not doing well at the moment? Briefly, out of sheer curiosity. Okay, so the US stock market has been doing well, particularly because of the Fed. They have been pumping lots of money in the economy and propping up the economy, right? So there's a lot of liquidity and some of that money is flowing into the stock market. And also we have gone back to reviving the economy quite a bit. People are back to work. People are being vaccinated. So the future is looking a little brighter than it was last year. Yet AFK, what's happening in Africa? Most of you haven't been vaccinated yet. There's a lot of issues with the economy. So AFK won't do as well because the market is saying it might take you guys a little longer to come out of the pandemic. That's most likely why. Okay, let's see. KW Web is down 50%, correct? Because is it because of the China government crackdown? Yes, you're right. There is a crackdown going on in China, particularly in these sectors that are huge. Alibaba actually got a fine. Didi listed in the US without their approval. So there's a huge crackdown right now. But that's an opportunity. Anytime you see a stock fall 50%, yet the fundamentals are okay, that's an opportunity to buy. It's not an opportunity to run away. So if you look at a chart for Alibaba, which is very intriguing, and let's say you wanted to start a position on Alibaba. Let me go to that chart. Alibaba, right there. Right now it's trading at 160. And now you notice that it's actually trading back to 2019. So whoever bought in 2019 has seen their money double and come back to breaking even. So if you had bought in 2019 and you only had 50 shares, what are you thinking right now? Are you thinking to sell the 50 shares or to add 50 shares? Because see, this movement, this crackdown, there's nothing wrong with Alibaba. The company itself actually has not changed. Will it go back to trading at 300 in a couple of years? You bet it will, because nothing wrong has happened with Alibaba. So that's an opportunity for you of getting into Alibaba right now. And even if it drops further, let's say it goes to 135, even better opportunity. So these are opportunities that you look for when you see such a drop, yet the company is just doing very well. Okay, let's see. Terry, can you talk a little bit more about the options trading class? Okay. All right, so the options trading class is a derivatives asset-based, and that is 8 sessions that we offer here with 3 practical apps. And what the option class actually gives you options for real, because what it does is help you participate in the stock market with the little money. You can use just a little bit of money using options to participate in the stock market. I'll give you just one example. I don't know how much more time I have. Let's say, and I have mentioned this previously, let's say we were looking to buy SoFi. I don't know whether, Terry, you know SoFi. And SoFi is a fintech company, deals with student loans, investing, all that stuff. So this is a chart for SoFi in the last 1 year. And it's back to around 15 bucks down here. It had gone all the way to 24, actually all the way to 28. Now it's half, 15 bucks. How do you use options to buy SoFi? You can buy the stock and spend, let's say you wanted to buy 100 shares. You can buy 100 shares of SoFi and put money to work, 1,500. Okay. Now with options, you can get into a contract to buy SoFi, and let's say that contract expires in 2023, so 2 years from now. The option market will give you a price to get into that contract. And it could actually, right now, when I was looking at it, it was around $6. So that's $600. Instead of spending $1,500 to buy 100 shares, you would use $600 to get into a contract for 2 years. In 2 years, let me ask you, do you think SoFi will be trading at 14 or 28? Or in the next 2 years, will SoFi trade at, let's say, $20 or $17 or $22? Yes, you know for sure at one point in 2 years, SoFi will probably move back up. Now, this contract that you have, you can easily change into obtaining those shares. So if it's trading at 28 in 2 years, you can go to the contract holder and say, remember we had a contract that I would buy SoFi at $15? Yes. Remember you only spent $600. Now it's trading at 28. You have the right to get SoFi at $15. It doesn't matter what price it will be. It might be $100. You have the right to get $15 SoFi at $15. So that's just one way of participating in options. There's a lot of other ways. And that class gives you opportunities to trade in the stock market using leverage and using a little money to hedge or even participate in big companies. Okay, let's see. AFK. Is it time to buy AFK? All right, so if you believe that Africa is going to get back into pre-pandemic levels and do well like it was, the economy will start growing. So AFK might be your opportunity. So look at the expense cost, the expense ratios, and consider whether, yeah, it could be, because right now it's actually down. It's not doing as well as SPY. That could be an opportunity. The same way we talked about Alibaba. Anytime you see those drops and you notice that there is really nothing wrong, the economy in Africa will rebound, then AFK might be your place. But also think about dividend. Is it giving a dividend? So you can collect a dividend while you're waiting for the index or the ETF to go back up. Okay, let's see. The Chinese stocks stand on dishing out equities. Okay, all right. All right, fintech, correct. Okay, I don't see any other questions here. All right, thank you, Terry. Thank you, Asaf, for the questions. James, I think we have answered. Jacob, awesome. All right, I don't know whether how does gold do now? All right, this is another question from someone. Gold actually, remember there is now a problem with hedging. Gold has always been the standard. If the market is not doing very well, most people would run to gold. But since Bitcoin has come around, a lot of people now are allocating some of the money to Bitcoin. And that's why gold is struggling quite a bit. But there are still opportunities in gold. If you are looking to hedge, gold is usually one way of hedging. It's not necessarily because it's crazy volatile. It's just one way of hedging. You're thinking there'll be a bear market in the next couple of years, then you allocate some money to gold. Okay, let's see. All right. Oh, thanks, Ed. Edu, thank you. Palantir. Oh, so you are participating in Palantir? Yeah, very cool. Very cool. Recently bought yeah, it did. And actually between gold and Bitcoin, so some firms are allocating monies to either Bitcoin or to gold because of hedging. Yeah, you're right. So then instead of buying gold, why don't you buy Palantir? That's buying gold. Okay. All right, very cool. I think we are good here. I don't see any other questions. You can reach out to me at any time. Let me finish up with this. Give you my contact information. You can text me, you can send a note. Here you go. These are my 2 phone numbers. If you want to send a text using my Kenyan phone, it's right there. My US phone is right there. This is our email address. You can go to our website too and establish a chat. And I do really appreciate your time. I hope I gave you something to consider on ETFs. And if you are lost a little bit, do not hesitate. Just to reach out and say, I'm considering that market, or I would like to take a class. We'll work with you. Edu is here. I don't know whether Chalo is here. Ed, and all those have taken classes. And we can actually give you their phone numbers. You can talk to them. How was their experience? They have established accounts. We can help you establish those accounts and get going. Think about 2 years from now, 5 years from now, what are you going to be doing with your money? All right. Lastly, Nelson, what ETF does it have to operate within the same sector? Or, yeah, you can diversify. Like I mentioned, there are so many ETFs. You may have come late, but there are so many ETFs to choose from. Take the recording that we did, go back if you missed a little bit. I think this recording will be available to everybody. Okay, I think we are good. I'll stop sharing right now. And Rufus, I don't know whether you're still here. Maybe not. Okay, all right, guys. I appreciate it. Now I can go get a cup of tea and you guys can go back to enjoying your afternoon. I really appreciate you guys. And thank you so much. Have a wonderful day. Thank you.